Hello, good morning and good afternoon. Welcome to this webinar where we'll be looking at the outcome from the US FOMC meeting this morning. Dancing in the dark was the title of the webinar, but as Jerome Powell put it this morning, it's more like driving in the fog. Obviously, trying to make these big policy decisions when there's a bit of a lack of public data available does make it more challenging, although the Fed largely stuck to the script this morning, cutting interest rates by 25 basis points, as was widely priced by the market and expected by most market commentators. So over the course of this webinar, we'll be looking at what we heard from Jerome Powell, dissecting both the statement and the press conference in terms of how we think about the US economy in relation to what the Fed's thinking, and whether that really changes our view on the direction of monetary policy from here, as well as our view on the markets, given we are in the midst of the US earnings season as well. Now, before we get into all of that, just a quick note that you can download a lot of the materials that I'm going to use today from our website on a daily basis. We do publish a daily version of our guide to the markets. And if you'd like to hear our views more frequently on how we're thinking about markets, asset allocations, and the topics that are most relevant for investors today, we also publish our On the Mind of Investors podcast each week that's available through various streaming channels. So what did we hear from the Fed this morning? As I mentioned, very much largely sticking to the script, that 25 basis point rate cut that had been flagged back in September. If we look at the dot plot was telling us and the statement of economic projections, it's what the Fed told us they thought about the economy back in December. So the Fed funds rate now sits in that band between 3.75 and 4%. But a lot of the conversation that we're going to have is not just about what we saw in terms of that rate cut, was the fact that there is a little bit more of a fragmented looking Fed coming through. We obviously saw two dissenters to that decision to move rates today. One was for a more aggressive downward move of 50 basis points by Stephen Moran, well-known dovish member that came in at the start of the last meeting. And then one that was for a hold on rates, given the fact that there is a bit of a lack of data to really assess how the economy is doing, and that today's decision may have been based on slightly stale data that we have had in the past, coming from both the labour market and the inflation report. And that was the Kansas City Fed Chair that dissented at this meeting. So a little bit of fracturing opened up. That did raise the prospects for what the outlook would be for the next meeting in terms of whether there is more data available or whether there is going to be continuation of the government shutdown, which I'll come on to. In terms of the views of the Fed, they did come off a little bit more hawkish. Overall, there was definitely more of a hawkish tilt to both the press conference, Jerome Powell pushing back on some of the ideas that a December rate cut was a foregone conclusion, as the market had been thinking about. We have seen a bit of a shift in pricing for the Fed over the next couple of meetings. So now we're only looking at the market, which is illustrating about 16 basis points of easing by December, so not a full rate cut. And then 27 basis points by January. Again, only thinking about one rate cut by the early part of this year. But the big pullback from what the market had been pricing. And similarly, we've seen bond yields rise both at the sort of 10-year maturity and obviously at the shorter dated 2-year maturity, as that has been reflected. So you're effectively getting a bit of a bear steepening in the yield curve overall. And equities were rather flat coming into the close, perhaps a little bit more preoccupied, thinking about some of the big tech names that are reporting after market close overnight. So when it comes back to that Fed story around what they think of the economy, how they were factoring in the decision for that rate cut at this meeting, again, the commentary was rather more hawkish. They were thinking about the fact that the inflation numbers have been a little bit more persistent coming through, that there was risks to that, and really framing this rate cut as more of a risk management cut rather than anything else. Somewhat more of an insurance policy rate cut, given the way the market had been moving and given some of that uncertainty, particularly when it came to the labour market, but some recognition that the economy was doing okay in terms of that growth outlook, and that there was potential for, a sort of slowing momentum in the labour market, but perhaps one that's not necessarily as dire as had been expected. A little bit harder to really get to that conclusion without that non-farm payroll data coming through. So there is a strengthening of differentiating views across the Fed coming through because of those dissents. But it does seem that they're prepared to think more around those dual policy mandates in terms of inflation pressure and the downward pressure in the labour market, and thinking around whether that's going to be the driving force and keeping that optionality open when they come into the December meeting. I would say when we look at the inflation numbers that we got most recently, that delayed September, print for the inflation pressures, we would generally agree with the Federal Reserve that a lot of this inflationary pressure you're going to see in the US economy is going to be rather temporary. We do think about inflation that's going to move higher through the middle of next year, both because you see some of the impulse of the additional fiscal spending coming through as you see those tax rebates come back to households in the early part of next year, as you think about the impact from tariffs starting to come through, something that really hasn't been seen in the inflation numbers just yet. You can see that there's been a lift in the core goods, so part of the inflation basket there on the left-hand side. You've also seen these sort of downward forces from both the shelter costs, which are a much more slowing movement component within the inflation basket, starting to come down. And certainly when we think about that right-hand side chart there, you can see core services ex-shelter, that inflation number had come down a little bit. So with that services side, there hasn't been so much inflation pressure. And we do expect that pass-through from tariffs to continue to be put through to consumers from companies, and that will lead to that higher inflation pressure coming through. But by and large, that level resetting does mean that, once that year-on-year comparison starts to come out, you then again think about those inflation pressures coming off. We would also see that, the economy is moving in a bit of a roller coaster fashion. We're seeing softness in the growth outlook as we moved into the end of the year, but coming into the first part of next year, you'll get that feedback from that fiscal stimulus, that delayed impact perhaps of these monetary policy cuts, and a little bit more growth expected in the first half of 2026, before again fading off in the back half of the year. And again, that reduction in the growth outlook, that softer demand profile that may be there, that reduces some of that inflationary pressure as well. So we don't think that does mean that you can see potential for further rate cuts in 2026, even if the market has started to discount this overall. Furthermore, when we look at the growth momentum in the economy, it's a little bit hard at the moment without the official numbers coming out. We're relying a little bit more on survey data that's come through. We're thinking about the ADP numbers on the payroll side. We're thinking about the PMIs, the ISMM, that are going to come out this week for the manufacturing and service sector. There is a little bit more momentum in the US economy than perhaps had been expected, but we do know that's a little bit uneven. I think you're seeing somewhat of that K-shaped recovery still coming through. We are thinking about some of the changes that are impeding the lower socioeconomic groups on the policy front in the US, and the benefits that will stream through to some of those middle to higher income households in the US, shaping the way we think about the US economy. In the terms of these survey numbers, what it means for manufacturing and survey, drilling down into the components, you can actually see that there was a little bit more of a softness in a new orders component, which would suggest that you are getting it new orders expanding, which suggests you are seeing that demand come through, but at the same time seeing that softness in the export side of these numbers, again reflecting some of the impact from those tariffs coming off, those exports to China, to Europe really slowing down. And so there is a bit of a drag being created from those new tariff policies coming through. Importantly, you're also seeing inventory start to rise within finished goods in the US. And then, again, this does reflect some of the build-up in inputs we saw earlier in the year. Obviously, they become finished goods in the end, but it can also reflect that there's that softness in demand that may be there, and those inventory levels starting to build up to suggest that companies are having a bit of a tougher time selling that, and that would be softness in demand that may come through. So we do look at that quite closely, particularly in the ISM numbers, because they have been quite a good proxy for global demand in the economy. We look at the GDP numbers as they come out. Finally, on the prices side, we think about how we relate these services and manufacturing surveys back to the inflation front. We are seeing those pick up in the input prices for both services and manufacturing, and that does suggest that eventually these will get passed on to consumers and end users of the moment, but we aren't seeing that prices paid index come up. So it does appear that companies are willing to sit on some of these increase in prices, as we're seeing reflected in the official PMI and CPI numbers, as they wait, perhaps being a bit more surgical as they pass on these price rises, or perhaps waiting for that opportune time when households and consumers have a little bit more money from those tax rebates and the ability to pass on those higher prices into next year. So it does feel like that inflation pressure is there, that these surveys show there's still momentum in the economy, but the underlying mix is definitely changing in terms of what we would deem to be perhaps a softer outlook coming through as we think about the latter part of next year. That does all mean to think of it about reflecting on what the Fed was saying today in terms of some of that modest but still decent growth they're seeing in the economy. Obviously, some of that softness is there. Thinking about their inflation views in terms of discounting how persistent will be in terms of their dual mandate, obviously focusing more on the softness in the labour market, and then thinking about what that means for the December rate cut meeting. We had been thinking about a December rate cut as being something that was probably more likely than not. Today's meeting just opened a little bit more of optionality to seeing that come through. But I do believe that our assessment of the economy is again in that moderation in the labour market, that softness in demand for jobs is still very evident, and that would more than likely keep the Fed towards easing in terms of more of these risk management cuts, being really to look through some of those inflation pressures that are there. But again, it does depend on the progress on the government shutdown and how long it does stay closed for. Theoretically, today, if the economy or the government reopened, the Fed would get a bit of a backlog of economic data. They would potentially get a couple of jobs prints, another inflation print before they met in December, arming them with a lot more information about the direction of the economy and therefore the direction of the outlook for monetary policy. However, if we do see the government shutdown continue into early November, the amount of data they get just becomes more restrictive. And then if it's into late November, there's a good chance they don't have any more data. And so they're really operating off a stale view of the economy. And that may lead them to be a little more hesitant to cut rates when it comes to that view without a good understanding of where the economy is going. Now, even if the government does reopen, relatively quickly, which seems like a bit of a hard task at the moment, given the loggerheads we're seeing between the Republican and Democratic parties at the moment, there is a bit of a delay in getting this data out. There will be somewhat of a fashion in terms of that data coming through in a timely manner for the Federal Reserve or for others. We saw that back in 2019 when the government did shut down. It took some way for the actual months of catch-up, those inflation and the labour market data to come through. So it won't be instantaneous as it was. And particularly on the inflation numbers, they may end up being more survey-based than actual reported numbers, and it could be that volatility that keeps through. That may mean the Fed is a little bit more hesitant to discount some of what that tells us. On balance, our view, as I mentioned, is for a softer economy, soft demand and labour, so we still think that rate cut in December is more likely. However, given the hawkish nature of what we saw today from the Fed, it does feel like they're pushing back on some of that narrative around the policy influence from Washington and wanting lower rates and thinking about the number of rate cuts we may see in 2026. Now, the market before this meeting had been thinking about 100 basis points of easing. So that was this meeting, that was December, and then a couple of more coming through in the early part of 2026. That December meeting looking a little bit less likely, that pricing coming out for the next meeting in January as well. It does suggest maybe we only get one rate cut through the first half of this next year. And so that slower path downward when it comes to thinking about the trajectory of policy rates as they move back towards something that could be considered more neutral, which would be about 3%. Now, Jerome Powell did think the current policy settings were still a little bit restrictive, so there's still case for further easing. But we've seen an economy that, again, proves to be remarkably resilient in the face of a lot of what we're seeing in terms of those policy dimensions. There's PMI numbers that are pointing towards relatively positive momentum in the economy, a labour market that's certainly cooling but not yet collapsing, and the realisation that we're going to get a little bit of more of economic support over the coming couple of quarters before fading off, maybe keeping the Fed a little bit more hesitant in terms of just how far they grow on this rate cutting cycle as they move down towards that 3% level. Now, how do we think about this being reflected in the markets, given what we've seen? The market, again, as mentioned, has moved back on the fixed income side in terms of the repricing in bonds, but it hasn't really changed our view when we think about risk assets more broadly. We're still in an economy where we can see markets that are being supported not just by economic expansion, even if it is around about trend-paced growth in the US and around the world, thinking about easy monetary policy coming through, easier fiscal conditions that are being supported by that, and even on those big policy dimensions when it comes to that trade outlook, it does seem that the US and China is pursuing this policy dimension, which is very much an escalation to eventually de-escalate. And that's really what the news flow suggests at the moment, whether it's regarding some of those very large 100% tariffs that have been seemingly put off the table, the meeting that's going to happen between President Xi and President Trump this week, the announcements around perhaps dialing back some of those fentanyl tariffs. All that suggests that we're going to see a little bit more de-escalation on that policy front when it comes to trade, and again, alleviating some of those concerns for the market. And in the meantime, we've had very supportive equity markets in terms of what we're seeing on the earnings front. We think about the current earnings season we're seeing in the US. We're looking at tracking a blended earnings growth rate that's based on what's been reported and what we're expecting based on the consensus earnings growth of a little bit of over 8% for the current quarter year on year. Now, that's still very good. That's roughly in line with averages. And we're seeing a number of companies outperform in terms of those earnings growth numbers. So we're running at earnings beats of around about 80% compared to what would be an average of around about 76%. And we're also seeing the earnings surprise running at about 7% compared to an average of about 6%. So we're still seeing a little bit more of a beat when it comes to the earnings outlook. And certainly just overnight, looking at some of the big mega cap names that have reported, things that are sort of backing up the story about the return on investment and the announcement around all those very large CapEx deals and the prospect for that demand that may be coming through in the future, which should, by and large, give the market a little bit of confidence given some of the concerns and jitters it had around the circular nature of these deals coming through. So we do think about the fact that we see this earnings growth breakdown here in terms of the US market that continue to move higher, and earnings coming through supporting what's been a rise in valuations in the US this year. Those margins that continue to rise in aggregate, but again driven by what we're seeing in the tech story, all being quite positive, thinking about still a positive return from the equity market, even if we're approaching it a little bit more of a differentiated manner at the moment in terms of thinking around performance of various sectors, and as well as being the dispersion within the equity market that can actually be quite beneficial for a more active stance to equity allocation within the US and globally. Obviously, a very strong topic of questions we've had a lot of recently are about still this creeping back in concentration, the rise in the valuations in the US, which have come back to all-time highs, back to the pre-COVID levels. And this, again, being backed by this idea, you're seeing it very focused within a relatively narrow part of the market. Valuations have moved a long way. Not at their peak, though. They're not back to where they were around COVID for those mega cap names, but certainly we've seen that valuation story move a lot this year, and not so much for the rest of the market. It's gone up, but not nearly as much. It didn't sell off as much because those parts of the market weren't as highly valued, but it's still not necessarily as expensive as everything else. What gives us a bit more confidence around this is that earnings story, though. This was the number from the other day. It was 14% being driven by those top 10 stocks, about 8% driven by the rest of the market. Just updating for the news we've had overnight, it's more like 15% and 7%. So, the top 10 names are still doubling the earnings growth of the rest of the market. And so it does feel like they're going to continue to justify those higher valuations that are there and backing that up with that earnings growth coming through. And that story is, again, looking pretty consistent over the fourth quarter earnings numbers and then even a little bit into 2026. Although it is a case of seeing the rest of the market start to catch up in that regard, even if the top 10 names do continue to deliver double-digit earnings growth. So again, this would say we would still be very much leaning into that secular AI theme on the equity side. So that is in consumer services, that is in technology. I do believe this is something we are going to see persist for time. But we're also thinking about how the market is evolving in terms of some of that deregulation, looking at the performance of financials, which we very much see being supported in this environment, and maybe to a certain degree thinking about how parts of the consumer market may fare if we see those rebates come through, a labour market which is cooling, obviously unemployment rates that stay low given some of the concerns around supply, but we have wage growth that currently is running positive in real terms. I think the real opportunity, though, comes in the fact that we are seeing a broadening out in this dispersion in valuations in the US market in particular. So this chart just shows you the dispersion between the top 20% and the bottom 80%, the 80th and 20th percentile in the US equity market when it comes to valuations. The green line is the median stock there in the middle. And in the box there, you can see the dispersion in terms of where we are currently relative to the average. Now, that dispersion has started to widen out a little bit, from the average of under 12 to now just a little bit under 17 times. It had narrowed for a period of there as the market started to come back up, but that dispersion widening gives you an opportunity of thinking about mispriced stocks in the market, some of the sell-off that may be unwarranted, and a much more positive position thinking about the ability to drive alpha through an active approach to the equity market. So while there is so much focus on those top 10 names, we would be thinking about the opportunities that are broadening out within it, if it's within that AI same theme through some of the industrials, the utilities that may benefit from that, or potentially thinking about how we see that play through the financials, as I mentioned as well. This does create a market where you are going to see potential for alpha being much, much higher in terms of that dispersion. And not only from thinking about purely equity investors, it does create more opportunity for hedge funds as well, which can be very interesting if we start to think about the diversification benefits of hedge funds within a market at the moment. We're trying to think about how we build in more portfolio resilience through different strategies. When it comes to the global outlook for equities, again, it's the earnings story that matters so much here. While we do think the US still has a positive outlook and probably room to run, we are conscious that it has gone a long way, and we're thinking about some of the benefits to being more globally diversified in portfolios on the equity front at the moment. Quite a noticeable uptick in those earnings growth numbers across the board there. And it is, again, capturing more of that 2026 story, that easier policy settings we're seeing come through, the earnings growth that's backing that up, that no recession view as we see that moderation in monetary policy. And again, it's focused in terms of a pickup we're seeing a little bit in the Eurozone, but again, Asia ex-Japan, think about that tech story really playing through those North Asian economies, the movement we've seen in China, particularly around some of that tech story, the valuations that have moved higher this year, certainly, but from a very low base and things that aren't necessarily nearly as challenging when thinking about some of the challenges in terms of what we're seeing on the US side of things. And so it is a case of thinking more broadly, globally diversified. So we do look towards that. Japan is one, again, a big tick up there. Some of that Takeshi trade coming through there. We've had that positive view on Japan for a number of reasons. It has been the reflation of the economy that's been more pronounced. Now we're adding in the prospect for further fiscal support coming through, further support for consumers coming through, and also thinking about a lot of that movement we've seen, which is a little bit slower, but thinking about the corporate governance changes that have come through, the increase in share buybacks to support the market, all stack up for thinking about quite a positive outlook for the Japanese equity market. So whether it's Japan, China, we've seen those movement higher in valuations. They are only back to roughly aligned with their average levels. And we think there's the earnings growth there to support the market, as well as potentially seeing a little bit more of a valuation re-rating as we think about capital that moves away from the US into global markets for that diversification and growth benefit coming through. Now, on the fixed income side, we're obviously thinking about how we balance out that positive view of growth assets in a portfolio, but making sure we want to hedge against what is quite clearly, to our view, some downside risk to the economy. Think about the jobs market in particular as a key indicator of that, but we would by and large say there is always potential for disruptions on the policy front, and then we think about how we would mitigate some of that growth shock that would come through should it appear. And so we have been leaning towards thinking more around the role of duration of portfolio, particularly adding duration at the shorter end of the curve and where we see the bond yields going. Now, our view on where 10-year US Treasuries are going a little bit softer now, so we're thinking about trading that band range of 375 to 425, a little bit lower. We're about 410 today. Some of the inflation risk that may be keeping us a little bit more tempered from moving further out the curve, but our view is still with further rate cuts coming through, potentially in December and then into next year, a little bit different from what the market may now be pricing. And so that does create opportunity to add a little bit more duration at the shorter end of the curve if the market does come back around to our thinking of seeing that December rate cut being priced in. That more positive outlook when it comes to the economy and also leveraging ourselves towards what is quite healthy corporate balance sheets does mean that when we look at the credit markets, we understand that spreads are very narrow, but they can remain narrow for some time, and you are picking up a little bit more in terms of yield across investment grade, particularly into high yield at the moment. And just on that, obviously, there's been some news around what we've seen in terms of the leveraged loans default, some of the very high-profile defaults we've seen in the US. Now, we just stress that when we look at the default rates in the US, they are still incredibly low. The divergence between the defaults and the leveraged loan market, however, starting to widen up, as that's where we've seen that stress. The high-yield market has actually benefited from some of that shift towards levered loans in terms of that quality deterioration probably going into that market and leading to a high-quality, high-yield market. And so, again, we're thinking about those spreads that are narrow, that all-in yield still looking relatively attractive, and not seeing that default start to increase, which would really signal that strength. So I think from an income point of view, that buffer of that higher income, should those spreads start to widen, offsetting that a little bit, gives us a degree of comfort still holding credit within the portfolio, again, to generate that income when we do have that sort of no recessionary view at the moment when it comes to the outlook of the economy. Other asset classes, obviously, we're thinking about the direction of the US dollar, importantly. Now, the US dollar on the right-hand side or left-hand side of the screen, you can see that top grey bar down about 9% so far this year. A lot of that depreciation happened over the first quarter of the year around some of the concerns around the policy developments, Liberation Day. Over the last few months, it's kind of largely tracked sideways and then actually picked up more recently, and again, picked up overnight with the pricing out of those rate cuts coming through. Our view, has been that dollar potentially could have moved sideways over the end part of this year, but our longer-term view into next year, again, is for that depreciation to continue. Pace of that depreciation may not be as fast given what we've seen this year already, but we do think about that narrowing of growth rates between the US and the rest of the world being more prominent. We're thinking about that narrowing and rate differentials as well. Again, we do expect to see further rate cuts from the Federal Reserve. And we've also heard from central banks around the world, and we'll get more from Bank of Japan, the European Central Bank, coming to the end of their rate cutting cycle potentially. And that does mean if they stay steady and the Federal Reserve come down, that brings those rate differentials narrower. That should weigh on the US dollar, as we show on the right-hand side of this page. A lot of the gains we've seen this year have been towards the euro, has been the Swiss franc, some of those safe havens. A little bit more pressure recently coming up in terms of the appreciation against Asian currencies, We have seen Asian central banks probably going to see more room for cutting rates, not really too worried about the impacts on the currencies at the moment. And it does, again, open up a door, thinking a little bit more around emerging market debt and the performance of emerging market assets more broadly in a portfolio. Finally, just obviously we're thinking about more broader diversification of the portfolio, how that leans into thinking about alts more broadly. We're thinking about some of the diversification necessary against that inflation shock. So again, our view is inflation is going to rise in the US through the middle of next year before coming down again. The inflation outlook a little bit different around the world, but we want to be cognizant of the extra fiscal stimulus that come through, potential policy changes that may see some of that tariff money go back to households, the possibility for further fiscal stimulus in the US ahead of the midterms, which may surprise, at a time where you could create a little bit more inflation in the economy. So that does lead us to thinking about real assets a little bit more, where that inflation pass through, where you're still getting that income and getting, as you can see across the horizontal axis, that lower correlation to that stock bond portfolio. So we do think there's a good story in terms of, yes, fixed income protection against those growth shocks, but we want to diversify those diversifiers and thinking about the ability for some of these real assets to have inflation protection within them and diversify those diversifiers in terms of what we're seeing against the inflation shocks for a portfolio overall. So our view is very much one of still continued performance in terms of thinking about positive view on risk assets. We still want to be a little bit more moderate in terms of our return expectations, given the shift in valuations and ensuring we have that broad global diversification coming through across our equity mix, and thinking about a barbell approach across fixed income, as well as assessing where we can add in more alternatives to diversify in terms of that inflation outlook, or take advantage of that increased dispersion and perhaps volatility that may come through the market. The hedge funds are a great way to play that. Our view on the Fed from here, again, stuck to the script largely today in terms of that rate cut. Unlike the market, we do think it's more likely we continue to see that December rate cut come through, but given the softness we're seeing, or at least in our expectation and reading of the data in the labour market, which will probably be where the Fed leans into supporting that as they look through some of that inflation shock. But next year becomes a little bit more of a different story as we start to see some of that fiscal stimulus come through, perhaps some of the delayed response from that monetary policy cuts. And so the Fed may be a little bit more temperate in terms of how much easing they price in, and we'll get more of that in the next statement of economic policy, assuming the government reopens and we start to have data that's less stale in terms of the reading of the economy. Finally, I would just note on the changes on the balance sheet, obviously there was a big focus today, quantitative tightening coming to an end on the 1st of December, the Fed had been running off that $35 billion in terms of the holdings, some of that to address some of the funding pressures that you had seen in the economy. Now, while the Fed does have ample liquidity, if we look at its overnight reserves, they had been going back towards zero, and that was creating some stress. So this will be a little bit more addressing that. It's quite technical in nature. By and large, it shouldn't mean too much for the bond market, that mix that they're going to move away from holding of mortgage-backed securities to having a balance sheet that's mainly made up of T-bills and treasuries will be the direction from here. And they will be looking at portioning that to reflect something that's more like the outstanding bonds and bills on the market. So the balance sheet effectively mirrors what's in the market moreover. Now, this should be relatively technical in nature. It shouldn't upset our views around the bond market. Overall, I think a bigger balance sheet from the Fed does bring down like long-run expectations of perhaps where we would see fair value for yields, but not a huge amount. And again, that trading range for the US 10-year of 3.75 to 4.25 as we would see the yield sitting at the moment. So no big changes from today's meeting in terms of our views on the market. A little bit changes in terms of how the market is interpreting what was a slightly more hawkish tilt towards or from the Federal Reserve. But I guess if we start to see that data coming back through, that can change quite quickly. The Fed wants to keep that optionality open. I would say that the economy is continuing to cool. The inflation pressures will largely be temporary, and we'll see the Fed continue to ease policy on this backdrop. That one of no recession, easier monetary policy, still positive for risk assets. I'll wrap it up there. Thank you very much for your time and attending this call today. Further questions, please reach out to your JP Morgan representative and do look out for our next webinar coming through on the Fed or other topics such as our long-term capital markets. If you want more information, please do look at our guide that we publish every day or listen to our podcast that comes out every week. Thank you again.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.